Welcome, everyone, to the Don't Blow Your IPO webinar. I am Sam Boyd, founder and president of Confido Advice and Investments. And this has been a year of pre-IPO planning here at Confido. And so we wanted to put together some materials that would be evergreen for people who are in a position where they have significant equity compensation in a pre-IPO company, but also some material for anybody with high income taxes, a lot of capital gain exposure, or that are trying to diversify a concentrated position. So much of this will be catered towards employees of pre-IPO companies with equity comp, but we're also going to have some more broader strategies that people can leverage in here too. So thank you for joining us. A couple of formalities to keep compliance happy, and then we'll jump right in. You should be able to post your questions in the Q&A feature, which you can find on the toolbar. So feel free to just shoot those over as they come up. I'll either try to tackle them as we go, or I'll try to hold some to the end, or when it makes more sense to touch on them as we get through the presentation. All right, so first up, we're going to talk about the basics, an introduction to equity comp. So broadly speaking, there's three types of equity compensation that's used: ISOs, incentive stock options; NQSOs, or some people call them NSOs, non-qualified stock options; and then RSUs, restricted stock units. They're all taxed differently, and this is where it gets a little bit confusing for people. But just to boil it down, the top two, ISOs and NQSOs, are options, right? Which means you have to elect to purchase them. You've got a strike price, which is what you pay, right, to buy the option. And then there's an actual, value out there for what they're worth. It's usually a 409A value pre-IPO, and then it's whatever the prevailing market value of the stock is post-IPO. With RSUs, there is no election that you need to make. When they vest, they become yours. You own them at that point. You don't need to purchase them. But from a tax perspective, with an ISO, the key difference between an NQSO is that the bargain element, the difference between your strike price and the fair market value, this blue area, that gets added back as AMT, alternative minimum tax. I'm going to talk more about that in a moment. With an NSO or an NQSO, the blue part, the bargain element, right, the 409A, the market value, right, minus your stock price, what you pay for it, that gets added back as ordinary income tax. Now, from there, depending on how long you hold the option for, any additional gain from what you paid, the valuation, and the sales price, that would be taxed as a long-term capital gain if held for specific holding periods, depending on the type of option, which we'll get into. And then for RSUs, whatever the amount is, whatever the fair market value is on the date that it vests, that's just included as ordinary income, not AMT like an ISO, ordinary income like an NSO. And there's implications that come along with that as well. So let's dive a little bit further into ISOs. The big thing about ISOs is AMT. So if you're not familiar with AMT, every year you do your tax return, there's two calculations that are being run: your regular tax that you owe, right, your ordinary income tax, and this AMT component, right, the alternative minimum tax. It hardly ever shows up these days unless you have incentive stock options. That bargain element, difference between your fair market value and your strike price, that gets added back as income for AMT purposes. And if your AMT tax is higher than your ordinary income tax, you pay AMT. So fairly straightforward. The AMT thresholds, there's a certain amount that you get an exemption on. It's 140,000 for married couples, 90,000 for single filers. But from a sort of planning perspective, we look at the AMT decision sort of two ways. Do we want to maximize for our free lunch scenario, which means we're filling up that AMT budget? We're realizing as much bargain element or AMT so that we don't pay AMT tax, right? There's a certain amount every year. Everybody has a budget for AMT in any given year. And there's a certain number of shares that you should be able to exercise without actually triggering it. The alternative is to plan around liquidity, to say, hey, I don't mind paying some AMT tax because I want to accelerate the ownership of these shares. I want to get them into long-term capital gain treatment as quickly as possible. And there we're using a liquidity target to say, hey, I've got X amount of cash or access to liquidity, which we'll talk more about in a moment. And I want to use up a certain chunk of it so that I'm left with a certain amount of cash left over. And then we're looking at, okay, how much does it cost to exercise the shares? What's the tax that we owe? And then minus how much cash we want to be left with at the end of the day. And you can come up with a number of shares exercised that way. But those are sort of the two broad themes for how we think about AMT planning. So, opportunities around AMT, exercising earlier is really where you get the most bang for your buck. As that 409A valuation gets higher and higher and higher, right? It's less shares that you're going to be able to exercise, whether you're in a free lunch scenario, right? No AMT tax, or a liquidity planning scenario, right? Because the higher the 409A, the more bargain element you're adding back. So early and often is the idea. You get an AMT credit when you pay AMT tax. So this year, if you had $100,000 of AMT tax, in the following year, if your ordinary income taxes are higher than your AMT, so let's say $20,000 higher, right? You'd be able to use $20,000 of that AMT credit in the following year. So what we typically recommend to people is we go with a 1 year on, 1 year off, alternating strategy between ISOs, which are generating AMT and theoretically an AMT credit, and then exercising your NQSOs, which are triggering ordinary income tax, so that you can leverage that AMT credit from the prior year against the ordinary income tax that you have from your NQSOs. And then last, this is a sort of a recurring thing we'll come back to, the higher your taxable income is, the higher your AMT budget is, right? So if you had, a whole bunch of income that you recognized, either because you exercised NQSOs, you had a lot of RSUs vest, you participated in a tender offer, any of those scenarios is going to increase your AMT budget. The higher your taxable income, the higher your AMT budget. So what some people might do is pursue a tactical disqualifying disposition or selling your ISOs, either in a tender or if the stock is publicly, before you meet the qualifying disposition timeframe. And so what is that qualifying disposition timeframe? With an ISO, you need to hold the stock for 2 years from the grant date, not the vesting date, but the grant date, and 1 year from the exercise date to get what's called a qualifying disposition. If you meet that criteria, then you pay capital gains, long-term capital gains, on any increase versus your exercise price. If you sell it before 2 years from grant, 1 year from exercise, then it's treated much like an NQSO that's added back as ordinary income and reported on your W-2. So there may be a good reason to do a disqualifying disposition in a given year based on your tax circumstances. But for most people, we're trying to get to qualifying disposition land 2 years from grant, 1 year from exercise, to then pay long-term capital gains on any amount above your exercise price. Now, NQSOs. We talked about this before, but bargain element is added back for ordinary income tax purposes. So what are some of the planning opportunities that we think about to remediate ordinary income tax? Of course, there's charitable deductions, right? So you can make a contribution to a donor advised fund, right? You could also look at, a charitable remainder unit trust, a CRUT or a NIM-CRUT. You could even go as far as a private foundation, right? But those are all itemized deductions that would reduce your ordinary income tax, taxable income. We'll talk more about this also, but there's the short-term rental strategy, which is purchasing short-term rental real estate like an Airbnb or a VRBO, and meeting certain criteria so that you can then pursue a cost segregation study and bonus depreciation. I'll unpack that more in a minute, but that allows you to use depreciation against your ordinary income. There's the pretty, traditional route, which is, using the tax-deferred vehicles through your employer, right? So you've got 401k contributions. You could use a health savings account, an HSA. Depending on your circumstances, there's, of course, dependent care, FSAs, traditional and limited purpose FSAs, right? But all of those are tax deferral strategies that bring down your ordinary income tax. And then we always want to keep an eye on the new SALT deduction, right? Which is now $40,000. A lot of our clients that are in this position with pre-IPO stock, they find themselves, either in New York or California, where we have very, very high state income taxes. If your income gets above $600,000, you're fully phased out for the SALT deduction, the maximum $40,000 SALT deduction. So we try to play that limit, 500,000 of income to 600, you're fully phased out. Keeping income under 500,000, we get to use our full state and local tax deduction. And then, of course, there's self-employed planning opportunities. If you've got a side hustle or you have some self-employed or consulting income, there's a whole playbook there. where we use retirement plans, home office deduction, auto, depreciation, the list goes on. But keep in mind, if you have self-employed income and you're showing losses for, a prolonged period of time, three years or longer, you're going to run into the hobby income rules where, you can't use those losses to offset your other income. So something to keep in mind. But that passing through a loss through a self-employed, side hustle type situation will reduce the taxable income, so long as you're active in material. So planning opportunities, it, it NQSOs are particularly useful for tender offers in most cases because of the way that they're taxed. With a tender offer, you're selling your shares at that point, and you're recognizing ordinary income tax, right? And so if you tender an ISO, it's basically the same thing as tendering an NQSO. But if we want to participate in a tender offer and sell some shares, NQSOs are probably the best option because you might get preferred tax treatment with your ISO. So we would preserve those to exercise them and try to hold them for a qualified disposition. And then that additional taxable income, if you're accelerating NQSOs, that's going to increase your AMT budget, right, for also exercising ISOs. So moving on, RSUs, pretty straightforward. The big thing here is that they come in either single trigger or double trigger. So single trigger is the traditional RSU where you get taxed at the fair market value. And this is usually, you're going to see this with all, publicly traded companies. A lot of pre-IPO companies will have a double trigger RSU where you don't actually realize any taxable income when the shares vest. But once that trigger occurs, which could be a liquidity event like an IPO, or it could be a corporate action like a decision to transition to single trigger, which we saw with one of our pre-IPO companies recently, Anduril. They were not going public, but they had a corporate action to make them single trigger. But when that trigger occurs, that's when you recognize the ordinary income tax. And if you've got a lot of RSUs that were double trigger that then flip to single trigger, all that income is recognized at once. And so, there's a lot of planning that you need to do around that. But the planning opportunities it's very much the same playbook as for NQSOs, charitable gifting, short-term rental, self-employed deductions, 401k, HSA, so on and so forth. Those are all going to, impact your taxable income, ordinary income tax, taxable income the same way. But the sort of planning opportunity here is when you are taxed on your RSUs. So if they're single trigger, right, or right, when you get to the point of single trigger from a double trigger RSU, you've got a choice. You can either sell shares to cover the taxes that are due when they vest, or you could put in cash to cover that tax bill. And so the thought process is, hey, if I think that the price of this stock is going to go way up, there's a lot of opportunity costs associated with covering the taxes due with the shares that you own, right? Because they're gone at that point. So if we have access to liquidity, if we have cash, and we can push cash into, ShareWorks or whatever custodian that the RSUs are on, and use your cash to cover the taxes, you'll preserve more shares. And if those shares go up in value, you'll benefit. So overview, sort of how the different equity compensation, vehicles work. Let's talk about pre-IPO planning. So through the lens of goals and goal setting, liquidity being king and access to liquidity and how to get liquid, some proactive tax planning ideas, and then a little bit more on risk management. I think starting with goals, just to briefly going back in time, the evolution of financial advice, it started with products, investing in insurance. It then broadened out to, more financial planning type things, retirement planning, cash flow planning, estate planning. But the evolution today is really folding in all the stuff that matters, the why, right, behind what you're doing with your resources, flexibility, legacy, vision, purpose, connection. And so for anybody who's facing a windfall or, a liquidity event or pre-IPO or just on the verge of retirement, I always encourage people to work on what we call a statement of financial purpose. And so I'll briefly kind of walk you through this. If anybody wants a copy of this workbook, just reach out. I'll be happy to send it to you. So we start with the what, right? I always say, my greatest hope, is that, you'll be empowered to use money as a tool for living the best possible version of your life, however you envision that. And so we start with some questions like, what's your vision of perfect, right? Describe your perfect day in vivid detail. How do you define success? when it comes to your financial life, what does security mean? And what is a life well lived, right? If you look back, right? So let's talk through those different questions, work through them in the workbook. Step two, we do some value discovery to sort of figure out what are the key, core values that really would help to inform and define your statement of financial purpose or your why. So we've got a workbook and a checklist. We say, pick 3 to 5 that you think really, really resonate, with you or feel especially relevant or important in this chapter of your life. From there, we get into prioritization, right? To say, hey, am I currently aligned with these values? Let's rate yourself on a scale. How could you improve it? And so we inventory those values, say how closely do we align with them, and then why. Let's talk a little bit about how to get closer into alignment with those values. And then finally, get the why. Get to the statement of financial purpose, right? And we've got some prompts that we use. Money's purpose in my life is what financial success means to me. True wealth is, right? And some examples here. Money's purpose in my life is to feel secure, never be a burden on my children. What financial success means to me is working because I want to, not because I have to. Right? Or true wealth is time with family, mainly outside, and serving my community. And so the goal here is to really get to your North Star. And the reason I think this is so important and why I bring it up in a Don't Blow Your IPO workshop is because when the numbers get big, things get weird. And it's very easy to get, distracted. There's no shortage of sort of bright and shiny, things that you can throw money at, or, opportunities that'll come across your desk. So it's really, really important to get clear on your North Star and your statement of financial purpose and making sure that the decisions that you're making as the numbers get bigger and weirder, that they're aligned with your stated values and what's most important to you. So again, if anybody wants a copy of the workbook or wants to talk more about that, please reach out. I'll be happy to send it to you. Okay, so pre-IPO key consideration 1, access to liquidity. Access to liquidity cannot be understated for somebody in a pre-IPO position. It is very much a flip the couch cushions moment where we want to try to get as much liquidity or access to liquidity as possible. And the reason for that is, we want to exercise the options, right? It's a bit of a race to get to qualifying disposition land where we can have a capital gain, lower preferred tax treatment at the point of sale so you can diversify this concentrated position, right? And bring it back into your life, into the real world and use it to support your goals. So we're using cash to exercise options, right? And then we've got cash to cover the tax liability, right, in the following year. With NQSOs, you need to cover the tax liability up front at the point that you exercise them. So exercising NQSOs can be quite expensive at the time, depending on the amount that you're exercising. We've got to put in not only your ordinary income tax, federal and state, but we've also got to get the payroll tax in there. So FICA. And then of course, if you've got RSUs that are single trigger, right, getting the cash in to pay for the taxes that are due, so you can keep more of the shares. And then all of that is, not to get in the way of impeding your emergency fund, right? Making sure you've got enough cash on hand, for near-term goals in an emergency fund, you've got to, keep an eye on that as well. So, for all those reasons, cash is king pre-IPO. And so what are some of the, potential sources of liquidity? Right? These don't all work for everybody, and not everybody has access, to them. But, do you have a surplus of cash beyond your emergency fund? Right. Most likely the best and highest use of that, is going to be to purchase your pre-IPO shares. Do you have an after-tax investment account that you can access, either with a line of credit or outright? Can you get a loan from family with preferred terms? If you have an after-tax investment account, can you access a box spread loan or a securities-backed line of credit where you're pledging those assets in your investment account as collateral for a loan that ultimately you'll have to repay, right? You'll pay interest on. But these are typically interest-only loans with the securities-backed line of credit. And with the box spread, you don't have a payment until the box spread expires, which you could make a fixed term like 2, 3, 4, or 5 years. But usually, we're borrowing somewhere between 50 and 70% loan to value. So on a $100,000 portfolio, that'd be $50,000 to $70,000. Do you have a primary residence and can you access a HELOC, a home equity line of credit? Usually you can borrow, 80% loan to value. can you get a personal loan from a bank? And then, of course, there's 401k loans, which is typically the lesser of $50,000 or 50% of the account balance. So if it's, $150,000 401k, you can borrow 50. If it's a $70,000 401k, you can borrow 35, right? 50%. But the key point here is that accessing liquidity to accelerate share ownership is not without risk, right? These loans have to get paid back or you're using your cash, right? Not all pre-IPO companies are going to have, successful exits. And so you need to be, very, confident about the employer, confident about the opportunity, confident about the timeline, that this would occur, to really, use leverage for these reasons. But assuming that you are confident and that you understand the risks, again, we're trying to accelerate ownership, right? Cover the taxes, and get to a qualifying disposition to diversify. So let's do a little bit more on this AMT budget versus the liquidity budget piece. So, walking through this, I call it the double play. NQSO tendering your NQSOs, so you're selling your non-qualified options, right, during a tender to then do an ISO exercise. So in this example, you accept a tender offer of NQSOs to access liquidity, cover a portion of your ordinary income tax liability through withholding, and expand your AMT budget. And so in this strategy, right, we'd then be looking at what's the minimum AMT tax and maximum ISOs that we could exercise. So again, in other words, AMT budget means we don't want to pay AMT tax. We're going to try to exercise as many ISOs as we can to avoid AMT. The second option is, hey, I'm not worried about paying AMT tax. I really want to accelerate ownership of these shares. And so I'm going to come up with a liquidity budget, which is how much cash do I need to exercise them, plus how much tax am I going to owe? And then I'm solving for how much cash I want to have left over at the end. And I think we'll talk more about this, but one of the key takeaways is that so much of this is based on tax. And assuming you're not getting out over your skis and you have the liquidity to cover the tax bill, you don't want to let the tax tail wag the good decision dog, right? Like if it makes sense, to accelerate the purchase of shares versus having like the optimal tax outcome and those shares, double or triple or quadruple from there, right? You would have been happier exercising more shares than having the ideal, tax outcome in that scenario. So a couple of examples. The inputs here, it's a single person in New York. They've got, very early shares, $10 a share. They're able to sell them for $250, the tender price, paying 40% tax when they do that. And then they've got a 409A, right, which is their valuation. That's the amount that the AMT is based on, $550 minus $10, and a preferred price, what the shares are actually worth on the open market. And then they've got 10,000 shares, to tender. So in this example, this first person, regular person did not accept the tender, just, 150,000 of income. Their free lunch AMT budget is $35,000. If in this scenario, if you accepted the tender, your taxable income is now $2,550,000, right? That's 10,000 shares using this math on top of your 150 of regular annual income. Their AMT budget is now $658,538, right? So this is, all things being equal, the amount of shares, right, that this person can exercise, the one that took the tender versus what this person can exercise, is exponentially higher because they've got this big giant budget that they can fill up, right? And so in this example, at a 409A of 550, right, they would be exercising a boatload of shares. I'll show you the comparison chart in a second. And then this is the last one. This is somebody with an AMT, not an AMT budget, but a liquidity budget, saying, hey, I want to maximize the shares while maintaining $500,000 in cash after I've exercised and paid my taxes in 2027. And so I'm going to jump to the next slide to kind of look at these, but their AMT budget is higher because this is the amount of AMT they would realize and owe a bunch of tax, right? In the previous version, that person could realize 658,000 of AMT and owe no AMT tax, right? But this person is saying, hey, I want the AMT. I just want to be left with $500,000 of cash at the end once I pay my taxes and exercise the shares. So looking at these comparisons, this is 150,000 of income, no tender, right? They were able to exercise 65 shares to fill up their free lunch budget. Now that's great, right? Because the shares are worth, $38,494. And the cost, to do it was pretty, de minimis, $652. That's a great rate of return, right? It's a huge ROI, 5,800% ROI. Now, if you compare that to the AMT budget, right? This person, tendered 10,000 shares. Their taxable income was increased by 2.4 million as a result. And their free lunch AMT budget was $658,000. So not only did they tender the shares and sold the shares, and now they have cash, right? They've got $1.273 million of cash. Their AMT budget is $658,538. And so that means that they could exercise 1,220 shares before paying any AMT tax. So the cost is only $12,200, right, to get $719,000 of shares. They still have the 1.26 of liquidity from the tender. They only used, $12,000 to do the exercise. This is the tax that they owe. Not in April. This is withheld when they did the tender offer, right? It's a big increase from here, but it's withheld at the tender. Look at their ROI, right? 16,235%, right? The increase in net worth as a result, 1,980,672. And then, of course, if the shares were to double from there, right, it gets amplified to 22,000. And then the last one, just for comparison purposes, maximize the budget. So same variables, right? Same free AMT lunch, right? But this person is exercising 6,975 shares. It costs more to exercise, right? But it's a huge increase in the share value. It's $4 million worth of shares. And they've got a pretty significant increase in the tax that they owe as a result of AMT, right? This person owed no more tax, right, with the exception of what they withheld on their NQSOs. This person's going to owe 685,570 more. Now, after paying the taxes, after doing the exercise, they're still left with that target. The target was $500,000 of liquidity left over. They pay the federal tax, pay the state tax. And their ROI is going to be lower than this person's, right, at the onset, at least, because they picked up a bunch of additional cost, right, $685,000 of cost. But it's still higher than the person, right, that just, exercised 65 shares. The magnitude of net worth increase, though, is massive. So this is the whole don't let the tax tail wag the good decision dog, right? Paying AMT in this case didn't produce the perfect ROI. It was better than this one, right? This was the best because it solved for sort of perfection, right, at no additional tax cost. But you got $4.5 million of stock on your balance sheet, and a year later would be available to sell at long-term capital gain treatment for a qualified disposition. If that doubles from there, you're at 8.75, right? So AMT budget versus liquidity budget is different for everybody, but I wanted to give a framework for people to think about, how they're exercising their ISOs and what to think about. So let's move on from there to some of these pre-IPO tax strategies and talk about the short-term rental. So just taking a quick step back, typically rental real estate is per se passive. And what that means is if you have losses on your rental real estate and you're making over 150,000 a year of income, you cannot use those losses to offset your other taxable income. It gets suspended as a passive loss that you can ultimately use at some point in the future when you have a passive gain. But enter the short-term rental strategy. So there's three components to the test that you have to meet here. It's 100 hours of your time spent during the year. The average stay is 7 days or less. So think like a short-term rental, Airbnb, VRBO. And you provided extraordinary personal services like a la a B&B, right? Having all of the different things that go into an Airbnb, which become extraordinary personal services. But again, 100 hours in the year, average stay of 7 days or less, and nobody did more work than you. So think like the property manager or the cleaners, right? Nobody did more work than you. You meet those three criteria, right? And now all of a sudden, it becomes active and material, which means that you can take losses on that real estate against your ordinary income tax. This is when we then introduce this concept of a cost segregation study and bonus depreciation. And so everything the IRS looks at, any thing that's placed in service and as for business use as having a depreciable life. And what that means is you can take a loss on paper over some period of time, typically, for the depreciation on that capital expenditure that you put in service inside the business. When the big beautiful bill passed last year, they brought back bonus depreciation. The way that this works is any component to a home that has a depreciable life of under 27 and a half years, right, which is the normal rate at which you depreciate a rental property. You take the value of the structure, not the land, but the structure, divide that by 27 and a half, and you take a loss on paper over 27 and a half years. It would be the sort of typical approach. With the cost segregation study, a professional comes in and does what they call component depreciation and breaks apart all the components of the home, right? So vinyl plank flooring, a sink, HVAC, and assigns an actual useful life that the IRS provides us based on the type of component it is. And assigns a time period to it, 7-year property, 15-year property, et cetera. The way the bonus depreciation works is that anything with a useful life under 27 and a half years, you can depreciate all at once. You can write it off all in the first year. And that can create a really, really significant deduction. So I've got an example here. This is one we looked at, I guess it was about a month ago, Tennessee property, sort of lakefront situation, but the purchase price, 1.5 million. The land was only 185,000 of the total. So the structure was $1,315,000. And so we did an estimate, a low end and a high end estimate, and the baseline was that we'd have about 273,000 of depreciation that we would pass through on the low end, or as much as 339,000 of depreciation that we would pass through. So here's that high estimate. Normal depreciation is here on the left. It's 12,000 in the first year, 33 in the second, 33 in the third, right? If we do bonus depreciation, right, we're actually taking $351,230 of depreciation, right, in that first year. And the tax savings, assuming 32%, would be $108,348 of tax reduction by placing this in service. And so again, it's not for everybody. You have to want to be an owner of rental real estate and have rental real estate in your portfolio. But if that's part of your broader goal set, this can be a really, really compelling opportunity to remediate your taxes by implementing this short-term rental strategy. Again, 100 hours, average stay of 7 days or less. Nobody did more work than you in that year. I always tell people, if you're trying to implement something like this, pumpkin patches. Sometime in late summer, early fall, if you can identify a property, get it under contract and close, get it furnished, get it up and running, get it listed and operational, versus trying to start that in, say, January. If you've got property managers and cleaners, there's a much higher likelihood that you're going to pass that third test. Nobody did more work than me if you started out a little bit later in the year, right? So pumpkin patches. Another one that we talk a lot about with clients is the use of what they call a charitable remainder unit trust, or a NIMCRUT, a net income with makeup charitable remainder unit trust. So again, what we're talking about tax planning here, right? The previous one was using depreciation to reduce your taxable income. In this case, it's using charitable giving, charitable deduction to reduce your taxable income. So a CRUT or a NIMCRUT is an irrevocable trust. When you fund a CRUT, you get a charitable deduction, a tax deduction, itemized deduction for charitable contribution. And typically that's about 10% of whatever you put in. So if you put $1 million into a CRUT, you get $100,000 of deduction, or $100,000 of deduction, 10%. That also represents the amount of money that needs to be in that CRUT on the day that you pass away that goes to charity. Once you have the CRUT set up, you're given payment rights. And let's just use the example of 5% payment right. If you have a 5% payment right and you put $1 million into the CRUT, you're able to then take out $50,000 a year and use it for any purpose. The NIM in NIMCRUT, net income with makeup, means if I don't take that 5% in the first year, I can take 10 in the second, 15 in the third, 20 in the fourth, 25% in the fifth. And that's always based, that percent that you can draw is always based on the December 31st value and what your payment rights are. I'm doing a high-level overview today. We have a webinar coming up on this to go much, much deeper. But we call that stacking your payment rights. Inside of the CRUT, when you liquidate the stock that you put in there, so if you had highly appreciated concentrated employer stock that went into the NIM CRUT, you get a tax deduction when you put it in. Once the stock is in there, you can sell it and pay no tax because it's inside of the CRUT and diversify it right away and get it out of just the one stock and put it to work. When the money's in the CRUT, it's not being taxed. And the big risk in these is that whoever sets up the CRUT, if you pass away, then the money that's in the CRUT has to go to charity at that point, right? So it would leave the plan, right? Or if it was, two spouses, the other spouse would not have access to those resources. So what do? Typically two things. In that same $1 million example with a 5% payment rate, we would buy $1 million of 20-year term insurance on the person that funded the CRUT, right? 20 years, 5% distribution a year gets you to 100% of what was contributed. And if it was $1 million and they were to pass away at any point in that 20-year window, the $1 million of term insurance would come back and replace those assets. The other thing we'll consider is naming the beneficiary, right? The charity that the NIM CRUT goes to ultimately when you pass away as a private foundation that your family would be the trustees of or the executive directors of, so that they would still, control those resources. 5% has to go to charity of the balance every year. But there's instances where, you could compensate yourself reasonably as the director of the private foundation. Business expenses like travel as it pertains to the foundation's, charitable activities, right? Those could be, expenses of the foundation and not expenses of the person or the family. So again, very high level overview. If this is, interesting to you, keep an eye out for the invite to our philanthropic planning and liquidity event workshop coming up. And here's an example. So $1 million in the CRUT, we're assuming a 7% return. This is a capital gains rate, 23.8% with net investment income, state tax of 10. So, California, New York, 6% payment rights, what they can pull out. And then the charitable deduction of, $100,000. In this example, right, you've got the $1 million of stock, you put it in the NIM CRUT and sell it, you pay no tax at that point. In this example, you got the $1 million, but you paid the tax. So you really start with 662. Over here, we're pulling out 6% a year of that December 31st value. Here's the growth at 7%. And you can see that if this person paid the tax and, tried to replicate that same income stream of 60,000, over here equal to this one, it would only last for about 19 years. They'd end up with about 1.234 of distributions because they started from such a lower base, right? This person over here, over 30 years, their cumulative distributions would be, just a hair under 2.1 million, 2,087,000. And that's because they preserved the value in the early years. And all things being equal, same rate of growth, but then pulling the same amount of income, this one runs out. This one, continues. In fact, by year 30, there's 1.3 million still in the CRUT that would ultimately go to charity. Oh, and by the way, not only did you not pay tax when you sold the stock, you also got a $100,000 tax deduction in the year that you put it in. Couple other pieces on risk management before we get into post-IPO strategies. The basics, right? So we always recommend that regardless of, whether you're married, you're single, you have kids or otherwise, you get the basic estate planning document set up. So, revocable living trust, last will and testament with the pour-over provision to fund that revocable trust if you, forgot to title anything in it. And then, of course, financial and medical power of attorney and advanced medical directives. There's also advanced planning that you can do, before an IPO. And we just talked about the CRUT. But if this event or any liquidity event is going to push you over the estate tax limit, which this year I believe is $15 million federally per spouse, so 30 million combined. If you're going to be above that number, then we'd start looking at other types of estate freezing techniques, like an intentionally defective grantor trust, an IDGIT, spousal lifetime access trusts or SLATs, or a revocable life insurance trust. But those three are all estate freezing techniques to get money out of your taxable estate. The charitable remainder trust also does that. It's not an estate freezing technique. It's a charitable planning tool with an income stream. And then finally, marital assets. If you're planning to get married, an IPO is on the calendar, probably worth, discussing a prenuptial arrangement. And then, if you're already married, but this is sort of a game changer and you want, everything to be fair and have some rules for the road, a post-nuptial arrangement is worth considering. And if you don't want to do either of those things, you can always use an irrevocable trust to, get money out of what would be considered, marital assets, in most cases in most states. Okay, so we're here. We made it. It's the big day. We found our liquidity. We exercised our shares. We handled the taxes. We bought a short-term rental, and all that stuff. Right? We made it. So what are we focused on at that point? Is staying focused, auditing our buckets, implementing the proactive tax strategies, and then using history as context to set expectations around what comes next. So staying focused, revisit that statement of financial purpose. It becomes your North Star. Again, when the numbers get big, things get weird. It's really useful to have an anchoring sort of values-based lens through which you view your decision making and whether or not those decisions are in line with your statement of financial purpose. So it may seem a little bit squishy to go through that exercise. I think it's incredibly valuable, especially between couples who may have differing expectations or viewpoints. Having a joint statement of financial purpose can be really useful to avoid conflict. Know your dates, right? So you're going to be given a bunch of dates like the blackout period, exercise windows. Those will be very straightforward, and you'll sort of be told, what you can and can't do. And like the online portal where your shares live, like they will, adhere to those dates. But it's up to you to know if you've hit a qualifying disposition or long-term treatment on your ISOs, NQSOs, and RSUs. So again, qualifying disposition, 2 years from grant, 1 year from exercise, right? 2 years from grant date, 1 year from exercise date. Now you're in qualifying disposition land. You can pay the lower long-term capital gains rates at the point of sale. For NQSOs and RSUs, long-term capital gains reach 1 year from the point that you exercise the NQSO or from the vesting date of the RSU. So it's a little simpler than the ISO. And then last is revisit and refine your liquidation strategy. And this is where we get into the buckets and talking about the buckets. So what buckets are we filling as they pertain to our goals, right? Is it, financial independence or getting to the point where I'm working because I want to, not because I have to, or not working at all? Is it a home purchase? Is it philanthropic gifting, right? But what are they and what amounts need to end up in those buckets? I always tell people we concentrate to grow wealth and diversify to keep it. So you concentrate your resources into one highly concentrated position like employer stock. And then, of course, in a perfect world, there's an IPO and a liquidity event, and you grow your wealth significantly. But from there, it's a different playbook. You then need to diversify that position to keep it, right? Because regardless of the employer and the stock, you don't want to end up with all your eggs in one basket, situation when you could have secured, your financial goals and financial independence. And then I always say no FOMO allowed. Figure out how many shares you want to keep for nostalgia's sake or just for FOMO, and let's carve those out and keep them in the plan. But be prepared to diversify and fill those buckets. So what are the buckets, right? It's financial independence, right? If I want to be financially independent at 40, 45, 50, 60, 65, we can calculate that number. If we know your lifestyle, right, what we need for food, clothing, entertainment, travel, beer, and pizza, and your other competing priorities, right, we can back into what's that number and how many shares to sell. Then we get into paycheck replacement, right? Do I want a pool of resources that's kicking off income monthly so that I can maximum fund 401k, mega backdoor Roth, HSA, backdoor Roth contributions, you name it, or support mortgage payments, right? But passive income from the portfolio to support those competing priorities beyond just covering your living expenses or financial independence. Near-term goals, home purchases, funding education, supporting family members. Who are they? What are the amounts? What is the time horizon? Let's figure it out. Tax planning, right? Of course. What do we owe this year, right? And what's our capital gains budget? Philanthropic planning. How much and when is it going to be during your life or posthumously? And then to whom and how, right? And there is a playbook, depending on those answers that you can implement. And then, of course, continuing to monetize equity. So assuming you haven't exercised all of your, ISOs, NQSOs, and everything else, we still need to keep that train rolling, right? And continue that sort of year on, year off ISO versus NQSO to then use the AMT credit in those off years and just, get all of the shares purchased into qualifying disposition land and then ultimately diversified. And then setting expectations, IPOs through history, typically, if you go out 180 days, most IPOs are down, pretty significantly. The exception on this list here is Palantir. It was down, but not, it had gone up, significantly. It was much higher than the IPO price at that point. But most IPOs, at that lockup expiry, they tend to hit a trough, right? When people start to sell their shares. So, it's important to keep this in mind, and we're sort of seeing a very similar version of that with SpaceX right now. We're getting closer back to that, that IPO price. So after the IPO, right, this is where it gets interesting. I mentioned this before, but the playbook in the beginning is very much flip the couch cushions, accelerate share ownership, like do it wisely, don't get out over your skis. But how do we get these shares in a qualifying disposition land? As soon as that IPO hits and these shares are liquid, it's a completely different playbook. It's how do I diversify them, right, to fill my buckets and meet my goals. And so depending on the buckets, right, so financial independence, paycheck replacement, goal planning, tax planning, philanthropic planning, monetizing equity, there's a bunch of different strategies that could work. So, you could just sell and pay the tax. You could use a securities backed line of credit or a box spread loan to not sell the stock, but to still get liquidity from it, to borrow from it. We've got all sorts of different option strategies, covered calls, protective puts, or collars. There's exchange funds we'll talk more about in a moment. Opportunity zones come back in 2027, which means if you take your proceeds from the sale of not just real estate, but in this case, stock, and it goes into an opportunity zone or opportunity zone fund and is held for 10 years, the cost basis steps up and the tax is wiped out. So it's a very, very interesting opportunity for next year. We've got the NIM crud, right? And then, of course, we've got direct indexing, which we'll talk about in a moment, taxable long short investing, variable prepaid forwards contracts, donor advised funds, private foundations, short-term rental. But depending on your goals, right, each of these strategies is going to be relevant and salient, right? But some won't, and some cover multiple goals, right? And the key is understanding that your post-IPO strategy is not a silver bullet; it's a mosaic of strategies coming together to best accomplish your stated goals and the buckets that you're trying to fill. So another shameless plug, we're doing a workshop on this coming up soon as well, investment strategies for low basis concentrated positions, so stock with a lot of capital gain. I'm going to go over this at a high level now, but if you're interested in learning more, I'll have the dates of the webinars towards the end of the slide deck. I highly encourage everybody to come to this. But outright sale is certainly an option, right? You eliminate that diversification issue, right? But you're gonna pay the tax at that point, right? So it's the simplest solution, but there's maximum tax liability. Direct indexing, this is where we identify an index that we want to follow, and we insert the stock into that index, usually with some cash. You're still going to be pretty highly concentrated, right? Because we can't just sell the shares outright, but hopefully we can harvest losses over time, right? To whittle away at that concentrated position, use losses on the index to offset the gains on the concentrated position. If the concentrated position is huge, it's really difficult to pull this off. Then we get into our option strategies. These are really, really fascinating. If you're not familiar with options, again, definitely come to the upcoming workshop. But covered calls allow us to generate income on a concentrated position. We can use that income to cover the taxes that we would owe, the tax liability. We're not going to be diversified at that point, but we can slowly use that covered call income to cover the tax bill to diversify over time. A collar is a really interesting idea. When you have a collar, you're writing a covered call, which generates income to then buy a put, right? And a put is the right to sell a stock at a predetermined price. So we can set a floor under the stock price that says, hey, if it goes below this number, I've got the right to sell it for X, no matter how far down it goes. So that can be really useful. And then premium income, options very similar to covered call writing. We also have exchange funds. With an exchange fund, people with employer stock come together from all different companies. So you might have Microsoft, NVIDIA, Salesforce, et cetera, and they pool their shares together into an exchange fund. You then hold that for 7 years. And at the end of the 7th year, you then receive this diversified portfolio of positions from all the other people that had put their shares in. But it's a 7-year hold, and you don't get it. Nothing happens in terms of taxes, right? You don't have a taxable event, but you still have that very, very low cost basis. So if you wanted to then sell that diversified portfolio later, it'd be tricky. You'd have to pay the tax at that point. Then we get into tax-aware long short and variable prepaid forwards. These two kind of work hand in hand, but tax-aware long short is very much like direct indexing, but with leverage. So, the easy way to understand this is with the tax-aware long short, we're still, pursuing an index, tracking an index. But we're using leverage, we're using margin to extend it, right? So if we had $1 million in the portfolio with the tax-aware long short, that $1 million direct index would be $3 million. It would be $1 million of core positions, $1 million of long positions, and $1 million of short positions. Stocks that we expect to fall versus long position stocks that we expect to go up. If we can tax loss harvest, say 15% in a direct indexing account in a year, so if it's $1 million, 15% tax loss harvesting, we'd be able to generate about $150,000 of losses in a given year to offset capital gains. With that same example, the tax-aware long short, if we have 3 million instead of 1 million, we should be able to generate 45%, right? Or 450,000 of capital losses in a given year. And so at 45%, you could probably unwind a highly concentrated position in 2 to 3 years. So really, really fascinating. And then, the variable prepaid forwards, this is a contract that's really created using options, where we're able to borrow against the concentrated position up to a floor, right? So say 80%. That injects cash into your plan right away, where it could be deployed into something like a tax-aware long short, right? To then generate these losses. And then over a 3-year period or 4-year period, at the end of that period, that variable prepaid forward contract ends, the stock is sold at that point. But you've now, harvested losses on top of losses on top of losses for that 3 or 4-year period that you can use to, offset or eliminate the capital gain that's owed at the end of the variable prepaid forward contract 3 or 4 years from now. So a couple more thoughts on direct indexing and tax-aware long short. And again, we're doing a whole workshop on this coming up soon, but tax loss harvesting becomes impossible over time with direct indexing because you get to a certain point where you just you don't have any losses to harvest, right? And tax loss harvesting is more difficult in a small portfolio, right? You want lots and lots of positions. We use the Russell 1000 and Russell 3000 to increase the ability. But this long short strategy, regardless of where the markets go, whether they rise or they fall, because you have a long extension, stocks that you have high conviction will go up, and a short extension, stocks that you have a high conviction that won't go up as much as their counterparts, you can harvest losses regardless of market conditions, whether it's up or down. And of course, like ultimately, your ability to harvest losses, you can see here is increasing, more and more and more and more. This is a 200-100 model. So, 2 turns of leverage, $1 million becomes 3. You should be able to harvest between 33 and 58% of that, million or 3 million. In the first year, 56 to 93, right? So by here, you've basically harvested, 100% of the built-up gain from your stock by the 3rd year. And that the ability to do that just kind of wanes with direct indexing as the portfolio is getting bigger and bigger. So again, based on your bucket, financial independence, right? There's a set of options that makes a lot of sense there. If it's paycheck replacement, there's a set of options that makes a lot of sense. If it's a home purchase or goals or supporting family, there's a set of options there that makes a lot of sense. And so again, it's a mosaic of strategies. Now I wanted to do 2 case studies to end here, to say, hey, we got to the point of IPO, and here's 2 things that 2 sample example clients would consider. So say $5 million of stock that they paid $500,000 for, right? So 10,000 shares. You got your federal capital gains rate, state tax rate, and this is if they just sold 4 million of it, right? The goal here was to diversify 4 million of the $5 million position. Well, they'd pay the tax and they'd end up with 2.736 afterwards. In this example, we're using a mosaic of strategies here, right? So first up is a NIMCRUT, $2 million NIMCRUT, 6% payment rights. They've got a $120,000 lifestyle. This would be kicking off 120,000 a year, 6% of 2 million. They'd also pick up a tax deduction, 10% of the 2 million in the first year for 200,000, and that reduces their tax owed by 96,600. They also diversified 2 million right away. Let's say for the next million, they use an exchange fund, put it in, hold it for 7 years. They've got the income coming from here. They don't need these resources. At the end of the 7th year, they get those shares back and it's fully diversified. And let's say they sold $1 million worth just outright sale of $1 million. right? We've got, tax due 315, we've got the deduction that we get from the NIMCRUT, right? And then the net proceeds that would go to a direct indexing portfolio, in a municipal bond, portfolio. We could then put on top of that a line of credit for 390,000 or so. That's 50% loan to value, which if they had a goal of buying a house, that represents a down payment on a just under $2 million home. And they would still have the portfolio, they'd have the line of credit. And then we'd hold a million shares, right? So 4 million diversified, hold a million, put on top of that, an options collar to put a floor under it, or covered calls to generate income. What would the outcomes be, right? 4 million of diversification, number one, right? You concentrate to grow wealth, diversify to keep it. 2 million in the NIMCRUT, million in the exchange fund, 780 in the outright sale, 3.78 portfolio value compared to 2.7 over here for the outright sale on this example. So $1 million more. Capital gain is 315 due. But they got the tax deduction from the NIMCRUT. So the tax owed is 219 versus 1,263,000. They've got 120,000 of annual income for the rest of their life now, at 6% of the portfolio value. And that, is based on the portfolio value as it grows. And they're also going to know that $200,000 is going to philanthropy if that was part of their goal set. So that could work really well for this client based on their goals. In this example, we're sort of maximizing for a home purchase, right? Or maybe they're just not interested in the CRUT concept, and they don't have or let's say, for instance, they are philanthropically inclined, but they're not interested in the CRUT concept. In this example, we're taking 3 million of shares. So again, the goal is to diversify 4 million, right? We're taking 3 million of shares and taking a variable prepaid forward contract on it. So an 80% floor means we could get 2.4 million in cash from those $3 million of shares that you pledged to that contract. 1.5 into that taxable long short, 900,000 into direct indexing in municipal bonds. Let's say we also do 200,000 to a donor advised fund or a private foundation, right? It's going to get us that income tax deduction of 96.6, and then an outright sale of 800,000, right? So capital gain is 252. We got the 96,000 that we get back from our donor advised fund contribution. 643 is the net proceeds of the 800 from there. And then we add that to our direct indexing in our muni bond ladder of 900. Now we've got an after-tax portfolio of 1.543 that we can put a line of credit on for about 770,000. That represents down payment or purchasing power of just a hair under $4 million house in this example. Keep $1 million in the stock, covered calls, so on. Outcomes, right? 4 million of diversification, got our taxable long short, variable prepaid direct indexing immunity, the outright sale direct indexing immunity, portfolio value 3 million versus 2.7. Tax due 156 versus 1,263,000, right? No income necessarily coming off of it, but we still have the 200,000 of philanthropic gifting. So I think we're running up on time here, but the key takeaways are like this is exactly what we do at Confido. This is very much the type of planning that we're focused on, and we've got a multi-family office value proposition which incorporates not just financial planning and investment management, but tax preparation, estate plan document preparation, and all the strategies that I referenced: tax for a long short, box spread, direct indexing. You name it. These are all things that we've got a lot of experience in and we can employ for our clients. Next up, start with the end in mind, right? Statement of financial purpose and the bucket strategy. Like, you should know what you're doing and why, and have some qualitative and quantitative underpinnings to help you guide decisions. Because again, the stock price goes up, the values go up, and things start getting weird. Having worked with people that have been there before, I can tell you that's the case. So we want to have some values incorporated. And then cash is king, right? Pre-IPO. But accessing liquidity is not without risk, right? So we want to, again, very much a flip the couch cushions kind of moment. But at the same time, you don't want to get out over your skis and have a tax bill that you can't cover, right? Or have totally, drawn all of your liquidity with no emergency fund. So it's important to do some planning there. Next, don't let the tax tail wag the good decision dog, right? We could solve for the optimal perfect AMT scenario and the highest possible ROI, but it might make more sense to get more shares into your control and on track for qualifying disposition. Next, I've said it a whole bunch of times, but we concentrate to grow wealth, diversify to keep it. right? No FOMO allowed. However many shares you want to keep for, for FOMO purposes or for nostalgia, right? You should know those numbers and be prepared to diversify the rest so that you can reach your financial goals and not just be concentrated in one stock. And then last but not least, there's no silver bullet. It's a mosaic of strategies, right? Like you can see that there's a lot of different, tools in the tool belt, and there's a lot of different ways to get from A to B. The key is to know all these ways, right? Have a statement of financial purpose and a vision, for the future and the outcomes that you're looking for, and then, work with a competent, team that's experienced in this to put it all together and figure out which ones make sense to you. And so last shameless plug, short-term rental strategy, cost segregation, bonus depreciation. If you're interested in that option, the Airbnb VRBO depreciation strategy, we're doing that one on August 4th at 1 p.m. Eastern. Investment strategies for concentrated positions, so tax-aware long, short, direct indexing, option strategies, exchange funds. That's going to be on August 12th, Wednesday, August 12th at 12 p.m. Eastern. And then last but not least, if you want to hear more about private foundations, NIM-CRUTs, donor-advised funds, and also some of the estate freezing techniques like idjits and slats and eyelids, we're going to do that one on Friday, August 21st at 12 p.m. Eastern. And so with that, we are at time. I don't see any questions in the chat feature, which means I either did a really good job, or the content was a little too dense. But I guess time will tell. I'll take this opportunity for everybody to thank you for your business and more importantly your trust. We are here to help. So here's my contact information. If this information is valuable to you, or anyone that this would benefit from hearing this and getting an understanding of how we think about pre-IPO and post-IPO planning, please feel free to share it widely with people, and ask them to reach out. And with that, I will say thank you once more and hope to talk to you all soon.